Today is March 27th, 2020, and just over a month ago, the S&P 500 hit a record high of 3,386 on February 19th. On top of this record high in the stock market, unemployment had reached record lows, and other than some minor discussions surrounding a particular illness starting in China, things were looking pretty good for the first quarter of 2020. But here we are just over a month later with the S&P 500 and other market indexes plummeting over 30%. And just 2 days ago, we found out that nearly 3.3 million Americans have now filed for unemployment, which is by far a record high in the United States. And while it's easy to have a doom and gloom mentality, especially with the current news cycle, I think it's extremely important that we put these things in perspective. So today, let's compare this current market crash to all past bear markets in the United States and try to use these past experiences to see where the markets may be headed in the coming year. Let's jump right into it. What is going on, everyone? Welcome back to my channel. If you're new here, be sure to subscribe and click the notification bell so you know every time I post a new video. And thankfully, being locked inside under the current circumstances means that I'm putting out a lot more content, so be sure to subscribe. So for anyone like myself who has started investing in the last decade or so, this current market crash, if you want to call it that, is likely the first major correction that you or I have experienced in our investing lifetime. And while it's obviously a gut-wrenching feeling to see your hard-earned investments drop in price, we need to put things in perspective and understand that this will pass eventually. So for the first major market crash in the United States, we have to go all the way back to the year 1907, when the stock market lost 50% of its value following a major earthquake in San Francisco, California. The insurance companies quickly became bootstrapped for cash since they had to make large payments to a lot of different customers, and this meant that a lot of gold was being withdrawn and lending requirements became much more strict. Very quickly, the US economy had a "it's a wonderful life" moment on its hands, and everyday consumers began pulling all of their money out of the banks in fear that they would not be able to access their money if the banks failed. While this was obviously a very dramatic decline and a horrible natural disaster, it did lead to a lot of great monetary policy changes and one of the first bull markets in our country's history, with a 193% increase over a 4-year period following this bear market. For nearly 2 decades, the market went on without any major correction until 1929 at the start of the Great Depression. During what we now know as the Roaring Twenties, money essentially grew on trees for everyone, and individuals began borrowing exuberant amounts of money in order to invest them in the market, which at the time was skyrocketing. This high level of confidence in the markets led to extreme amounts of borrowing and therefore debt. And despite the Federal Reserve warning borrowers that this level was unsustainable, an unknown catalyst caused panic selling, leading to the greatest depression in the history of the United States, formerly known as the Great Depression. Not only did people panic sell their stocks and assets, but they once again ran to the banks with pitchforks, demanding to withdraw all their money because George Bailey. And just as George Bailey explains in that movie, the banks were unable to meet these demands since they had invested most of this money in different markets that were rapidly declining in value. This only exacerbated the problem, and in under 3 years, the stock market lost over 83% of its value. Yes, you heard that correctly, 83%. Again, let me quickly remind you that at the time of making this video on March 27th, 2020, we currently bottomed down roughly 34% from the absolute highs to the absolute lows in the last 2 months. Not only was this a historic decline in the stock market, but unemployment reached nearly 25%, if you can even wrap your head around that number. This level of economic crash was absolutely unprecedented, and there's a reason that we refer to this period as the Great Depression today. Thankfully, as I'm sure you know, World War II was the largest catalyst that pulled us out of this depression, since it offered employment to nearly 17 million Americans who were out of the job. This catalyst led to a near 14-year expansionary period and a growth of 815% across the stock market. Once World War II ended, the US economy did go through a brief bear market, seeing a 22% decline over 6 months, since many individuals returned from war and began competing for the jobs that were being filled while the soldiers were off fighting. Thankfully, this adjustment period did not last long, and the next bull market lasted over 15 years with a growth of 935% on average across the stock market. This 15-year period remains as one of the longest expansionary periods in US history that didn't come to an end until the end of 1974, when President Nixon removed us from the gold standard, which linked the value of the US dollar to the value of gold. As a result, the US began printing more money, which obviously led to runaway inflation, since each dollar printed meant that the dollars currently in circulation had less value. The removal from the gold standard led to a 42% decline in the markets in just under 2 years, but as always, investors regained their confidence, and this was followed by a 13-year period of expansion with a 845% return. This didn't end until the infamous Black Monday crash of 1987, when the Dow Jones Industrial Index lost 22% of its value in a single day. Thankfully, this unprecedented decline was largely a fluke event caused by a relatively new automatic trading system. As certain stop losses were triggered, the automatic systems began to sell, which caused the price to go lower, which caused more stop losses to be triggered and more sales to be made. Since these automated trading systems were relatively new, there were no policies or circuit breakers that we have today that automatically paused or stopped trading. Because of this, the automatic selling continued, leading to the single largest percentage loss in the history of the US stock market. This once-in-a-lifetime event led to further monetary policy and the circuit breakers that we have learned a lot about over the last few weeks. Thankfully, Black Monday was followed by another 13-year period of expansion that saw an average growth of 816%. This growth lasted until the burst of the dot-com bubble in 2001, when many of the internet companies promising a new way of the future collapsed due to their inability to actually make money. However, the few companies that survived saw massive success, and some continue to be leaders in the tech industry today. After a 44% decline caused by the dot-com bubble burst, we saw a 5-year period of expansion with a 108% return, which was halted by the Great Recession of 2008 that all of us know pretty well. Unless you're 12 years old and watching this, to which I say, good for you. Obviously, the Great Recession does not need much of an introduction, but in a nutshell, banks began lending way too much money to unqualified home buyers who eventually began defaulting on their mortgages for the houses they couldn't afford. This meant that banks were not getting paid, leading the stock market to crash 50% in just over 1 year. This alone should put the current situation in perspective, as we are still far from this 50% figure that was seen just over a decade ago. This was obviously followed by the longest and most profitable bull market that most investors my age have lived in their entire investing lives. And now, here we are today, having bottomed down 34% and showing good signs of recovery at the moment. Right now, you may be wondering why there has been so much hysteria surrounding the current situation, when clearly there are countless examples of markets that were far worse than this. I believe the first cause of this panic is the rapid pace at which the market sold off. In the past 4 weeks alone, we have seen historic days on the market with both positive and negative momentum. The sheer volatility alone is enough to scare most investors, especially those of us who have not been through something like this before. The second reason is obviously the simultaneous health crisis taking place not only in the United States, but around the entire world. The balance of solving the current health crisis without crushing our economy is a topic of great debate, and has taken our markets for quite a roller coaster ride. Right now, you are likely sitting in one of two camps as an investor. You either are sitting on cash on the sidelines, wondering when you should buy back into the market, or you've been holding investments throughout this crazy roller coaster ride, and you're currently wondering if you should cut your losses or hang on for a rebound. Regardless of which situation you're in, I want you to go back and look at every recessionary period that we just discussed. If you were to stay the course and draw a straight line across all of those bear and bull markets, you will obviously notice a strong uptrend. Now, it's easy to look back over the past 100 years and say that the data says you should buy and hold stocks. But it's a very different thing when you've lost a chunk of your life savings and you're also running desperately low on toilet paper. All jokes aside, you need to remember a few quick things. First of all, this too shall pass, and if anything, you should see the current situation as one of the best buying opportunities in a very long time. The best time to buy stocks was decades ago, but the second best time is right now. Don't let this opportunity slip through your fingers just because you're paralyzed by the fear of losing money. Yes, you may continue to see a lot of volatility over the next few months, and no stock market guru will be able to tell you where the market will be at the end of the year. But I can say with 99% confidence that buying now and holding for 20 years or more will lead to the best financial decision that you've ever made in your entire life. And if you've lost a lot over the past few weeks, then maybe now is an opportunity to decrease your average cost and use this as a chance to increase your profitability. Just because you're currently down in the year doesn't mean that you can't or shouldn't take advantage of this opportunity. And if you're currently looking at your brokerage account paralyzed by the red numbers across the board, I need you to remember that the only people who get hurt on a roller coaster are the people who jump off. Especially if you initially made your investment as a long-term play, don't throw that plan out the window just because of this short-term volatility. Stay the course of your original plan, and with consistent long-term investments, you will almost always come out ahead. Again, over a 20-year period, the S&P 500 has never yielded a negative return. So you are all but guaranteed to come out ahead if you just stay the course and ride this one out. If you're one of those investors who is extremely panicky and checks your phone multiple times a day, here's a suggestion. Don't do that. Find a hobby or anything to help you forget about the market and your investments. At the end of the day, if you are so paranoid and caught up in your investments that you can't enjoy your everyday life, then maybe you want to seriously rethink your investment strategy. Obviously, these are emotional and trying times for a number of reasons, but staring at your account worrying about every point change in the market is not going to change anything. If you are that paranoid about your investments, try not looking at your brokerage account and deleting any investing apps for at least one day. Constantly looking at your investments multiple times a day often leads to overthinking and will ultimately end in panic selling and throwing your long-term goals out the window. So hopefully I was able to give you some perspective on where the current market is at and where we may be headed in the future. Like I said before, there is no way to know where the market will be 10 minutes, 10 days, or 10 months from now. But I'm sure that stocks will be significantly higher in 20 years than they are right now. I want you to view this correction as an opportunity to grow as an investor and build your emotional armor for the long life of investing ahead of you. As always, let me know if you have any questions at all down in the comment section below, and I will be sure to get back to you. I really appreciate you taking the time to check out my video and look at my channel. So if you enjoyed the video, don't forget to smash the like button and subscribe for more videos like this in the future. Thank you so much for your time, take it easy, and I'll see you in the next one.